Good evening everyone, welcome to the official YouTube channel of Officer Survey 24/7. So first of all, let me know how are you all, and also let me know is audio video both are okay in today's session. And we are meeting after a long time, I guess after 3 days I am taking the sessions now on your IFS. Even the PPB session was not there from the last 3 days. So we will be restarting our session. As you know, Achiever series are going on, in which we have completed your module A and we had started module B. So on 25th of December, we had our last class. And on that day we have started our module B. So module B class number 1 have been done, and today we are going to start with the module B class 2. So as you know, IFS have 45 units, and every unit we are discussing in detail, and in the end we are also doing certain advanced questions for the particular units. So this is our second class. Those who have joined this session for the first time, I would like to inform you all that we are having regular sessions on Achiever series for your JAIIB May 2024 paper. PPB session is going on in the morning at 6 AM and IEIFS session is going on in the evening at 7 PM. Monday to Saturday, these sessions are available. If you have missed any session, you can find the session in the playlist. In the playlist, all the recording is available from your module A class 1. Okay, so let's start. In the last class we have discussed the module B class number 1, in which fundamental of economics topic we have discussed. That was the unit number 12, overall unit number 12 of yours. And today we are talking about supply and demand module B, that is your unit number 13. This is what? This is our unit number 13 of overall 45 units. And if we talk about module B, this is the second module of your module B, second unit of module B. That is supply and demand. So as usual, before starting with the MCQs, first let's discuss what this topic is. What is actually supply and demand? Then we will move forward to the questions. So first of all, when we talk about demand and supply, these are what? These are market forces. Demand and supply is a market forces. Everything depends on the market forces, that is your demand and supply. If we talk about supply and demand, we have two statements that have been given, like demand creates its own supply and supply creates its own demand. Is it true? And yes, both the statements are true. The economist Mr. J.M. Keynes and Mr. J.B. Say have given us these two statements, so both the theories are correct. If we talk about first theory, that is demand creates its own supply, this is very much true, because you know that whenever we demand for goods and services, supply will be provided for the same. Second, we have supply creates its own demand. Is it true? Is this theory is true? And the answer is yes, this theory is as well true. Reason behind it is that when we, let's say for example, we went to the market for shopping for the purpose of certain things. We have decided A, B, C, D, these products we have to purchase. We went to the market, and in the market we have seen something there which was not in our list. But still, after seeing that, we liked that particular product and we purchased this. And this happened with everybody. Like, we have not thought about this of purchasing the particular product, but still, we have found that in the market, we have seen the product, we have liked the product, and we have purchased that product. This is what? This is your simply supply creates its own demand, because the market was giving you the supply, you like that and you purchase that. That's what actually your supply creates its own demand theory is. It means both the theories are correct when you talk about demand creates its own supply and supply creates its own demand. Now, in this particular chapter, you have to cover your first law of demand. And law of demand says that there is an inverse relation, you can say opposite relation, you can say negative relation between price and quantity demanded. So whenever prices are rising, the quantity demanded will decrease. That have been said under your law of demand. It means price and quantity demanded have inverse relation. When it comes to the law of supply says that when we talk about price and quantity supplied, they both have a direct relation, or I can say they both have a positive relation, because when the supply is rising, when the prices are rising, quantity supplied will also rise. If the prices are declining, the quantity supplied will also decline. So law of demand and law of supply represent certain relationship between your price and quantity demanded and price of quantity supplied. Because it's a law of demand, the relationship between price and quantity demanded will be defined. That is the inverse relation. And because it's a law of supply, the price between price and quantity supplied will be defined. That's a direct relation. Okay. Apart from that, the certain terminologies are there we have to study. But in whole chapter, you will see one particular line that's constant. And that line is other things being constant. Other things being constant. Every time when you study law of demand, when you study law of supply, when you study types of demand, whatever you are studying in this chapter, this statement that other things remain constant will be there. So if when the prices are increasing, quantity demanded will decrease. This will only happen when the other factors remains constant. And if you say that if the prices are increasing, the quantity supplied will also increase. This will also happen when the other things will remain constant. Okay, so this is the basic of your chapter I have given you. Now let's start with the MCQ and you will find more concepts in the session. So first question in front of you is asking about demand schedule is the dash. Like what is demand schedule? So we know first of all we have to understand that the law of demand says that price and quantity demanded have inverse relation. Price and quantity demanded have what? It have inverse relation. And when we represent this relation of price and quantity demanded in tabular form, that will be known as your demand schedule. So what is demand schedule? Demand schedule is simply when you represent, demand schedule is simply when you represent, when you represent the relation between price and quantity demanded on a table, that is your demand schedule. So first is saying relationship between demand and quantity bought, not. Relationship between and quantity demanded, this is true. Relationship between income and demand, no, none of these, so right answer is B. When you represent the relationship between price and quantity demanded on a table, that is known as your demand schedule. So your right answer will be B. Okay. Now second question is asking about a kind of a lengthy question you can see, but it's a very simple. Always remember, questions will be lengthy, language will be tricky, but if you know the concepts, you will be easily able to answer. So do not panic, do not have this stressed after seeing the paper, like this is a very long question, how to do that, and this will definitely be very what we can call tough. No, it's not there. If the statement based questions are there, they are also easy, like this one, like we will start with the elimination method. So you can see what is understood by law of demand, and I have just told you law of demand says that price and quantity demanded have inverse relation, but other things remains constant. This line will follow in whole chapter of yours. So let's start with the first option. When the price, we will eliminate the option first. When the price of commodity is raised and the other things not being constant. After seeing that, I will say this is not the right answer, because other things have to remain constant. So first is not correct. When the price of commodity is raised and other things being variable, you do not want things to be variable, you want things to stay constant. So second is also wrong. Third, when the price of commodity raised and the other thing being constant, it means till now it is very much true. Buyers tend to buy less of the commodity, and this is true. If your prices are rising, you will purchase less goods. And the next is saying similarly, when the prices are lowered, the other things being constant, again they are saying other things being constant, quantity demanded increases, and that's very much true. Your right answer is C. Okay, so the law of demand is defined under your option number C. Clear? Next question we have here, quantity demanded has a dash relation with price. Now I have just told you what relation the price and quantity demanded have as per our law of demand. First is saying positive, second is saying direct, third is saying inverse, and fourth is saying both A and B. So price and quantity demanded, they always have a inverse relation. It can't be positive, it can't be negative, it is inverse. It means third only. You can call it inverse, you can call it negative, you can call it opposite relation. All are correct in context of the inversely proportional. Okay, they move in what? They move in opposite direction. When the prices are rising, your quantity demanded will decrease. They move in opposite direction. Okay, so right answer is B. Clear? Next question we have, normally the demand curve will have a dash shape. Now what is demand curve? Let's understand that first. So when we know law of demand talks about the pricing and quantity demanded, the relationship between the both is your law of demand. Now the law of demand relationship, when it shows on a table, like what is the relation going on between price and quantity demanded, that is known as your demand schedule. When you represent the price and quantity demanded statement or relation on a graph, this is your graph. That is known as your demand curve. So when you represent the relation between price and quantity demanded on a graph, that is known as demand curve. And this is your curve. And in case of demand curve, your slope will always be downward. What is the upward slope? This kind of slope is known as upward slope. But you can see here, this is your what? This is your downward slope. This is your what? This is your downward slope. Clear? Now, you can see here how the prices will be defined. One second, let me show you how the demand curve will be maintained. Okay, and the last one is this. So let's say here we have taken price 3, then we have price 2, then we have price 1. Similarly, we will have the quantity 3, quantity 2, and then the quantity 1. Now you can see the relationship between price and quantity demanded here. So this is price, this is quantity demanded. So when you have the price 3 or when you have the price 1, you were purchasing the quantity 3. When you have price 2, you are purchasing quantity 2. When you have price 3, you are purchasing quantity 3. Sorry, 1. On the price 3, you are purchasing the quantity 1. Okay, so you can see as the prices are rising, your quantity demanded is declining, and that's actually your law of demand. That's actually the relationship law of demand is representing in front of you. Okay, this is how you can define the demand curve. This is your demand curve, which tells you about the relationship between price and quantity demanded on a graph, and this graph will always have a downward slope. Okay, and if someone asks what is the supply curve slope is, so supply curve, this is your supply curve. So supply curve have upward slope, but the law of demand have downward slope. Okay, do remember that. So I guess the basic understanding of law of demand, demand curve, demand schedule is clear to all of you. So your right answer is B, downward sloping. Next. The equilibrium price is also known as, now what is the equilibrium price? When the quantity demanded is equals to quantity supplied. This is your equilibrium price. When the quantity demanded is equals to your quantity supplied, that's your equilibrium price, and that is also known as market clearing price. That is also known as what? Market clearing price. Quantity demanded equals to your quantity supplied. Okay. Next, law of demand shows the relationship between, now we have just discussed, quantity demanded, quantity supplied, obviously no. Income, quantity demanded, no. Income and price, no. It is the price and quantity demanded. That's the relationship which law of demand shows. So your right answer will be C. Okay, so I guess till now with the help of questions, you now understand what actually the law of demand. I think every kind of question have been asked in this particular slide, in this particular PPT. And apart from that also, I have told you how the relationship will be checked on the graph as well. So I guess law of demand is clear to all of you. Now, next question we have law of supply. And it is asking law of supply shows a relationship between the dash. First, quantity demanded and quantity supplied, income and quantity supplied. Third is saying income and price, and fourth is saying price and quantity supplied. So I have told you law of supply have a direct relation. It represents us a direct relation between price and quantity supplied, and it have a upward slope. It have what? It have a upward slope. Price and quantity supplied we are talking about. Okay, so the right answer will be your what? D option, that the price and quantity supplied will be the relation that will be shown by the law of supply. So right answer we have is D. Okay. Next question. Demand curve is the dash. Now what is demand curve? When you talk about demand curve, what is demand curve? We have just discussed, which shows relationship between price and quantity demanded on a graph. Hana? So it means a demand curve shows the relationship between price and quantity demanded on graph. So first is the correct statement. Hana? When you show the relationship between price and quantity demanded on a graph, that's your demand curve. Right answer is A. Next question. Supply curve relates quantity supplied to dash. So supply curve relates quantity supplied to dash. So we have just seen that it shows the direct relation between the price and quantity supplied. When price increases, quantity supplied increase. So its relationship will be shown with which of the following? Supply, income, price or demand, and the right answer obviously is price. Right answer is obviously price, C option. Okay. Good evening everyone, welcome to the official YouTube channel of Officer Study 24/7. So first of all, let me know how are you all, and also let me know is audio video both are okay in today's session. And as you know, we have started our Achiever series and we are discussing module wise topics or units here. So in today's session, we will be talking about the module B of Indian Economy, Indian Financial System. Those candidates who have joined us for the first time in this session, I would like to inform you all that we have started this Achiever series from module A. And as you know, in IFS subject, we have 11 units in module A. So we have already covered the module A. In 11 classes, we have done one particular unit in our day. And after that, it means from 12th to 16th class, we have completed the advanced question on module A. The same we will be doing with the module B, then C and then D. So we have started module B, and module B starts from unit number 12. And today we have class number 3 of module B. It means we have done 12th class, 12th unit, 13th unit, and today we will be talking about the 14th unit of your module B, that is money supply and inflation. Okay, this is the third unit of module B, and overall the 14th unit of your IEIFS subject. So the topic name you can see here is money supply and inflation. So I guess you all have seen all the sessions, and if you haven't seen the sessions yet, then on the Officer Study 24/7 YouTube channel, you will find the playlist there. Go to the playlist, check all the session. Because the module A and B have some relation with each other, to understand properly the topics, the subjects, you have to cover the module A and B together. Similarly, this concept goes with the C and D module as well. Okay, so now if we talk about money supply and inflation, so what is actually money supply? What is money supply? Money supply, before coming through or going towards the questions, let's understand about the topic and then we will move towards the question. So first is talking about money supply. So money supply is simply the liquidity we are talking about. Liquidity means the cash flow. So what money supply is available in the country, it means what liquidity available in the country, it means what amount of cash is available in the economy. That's your money supply. And to measure that, RBI have introduced the measures of money. RBI has introduced the measure of money to identify and to know how much cash or how much liquidity is available in the country. And these measures of money is known as M1, M2, M3, M4, and we also have M0. Now the M0 is known as the base money, M1 is known as your narrow money, and M3 is known as your broad money. Do remember these other names because these questions can be asked, like the basic one-liner question can be asked, which of the following is base money, which of the following is narrow money, which of the following is broad money. So M3, M1, M0 are broad money, narrow money and base money respectively. Okay. Apart from that, these measures of money calculated by RBI, this will be analyzed by RBI to know how much liquidity is available in the country. Apart from that, this will be done on fortnight basis. It means for 14 days duration, RBI measure the liquidity in the economy with the help of these measures of money. Clear? Do remember, this is your money supply we are talking about. And on the money supply, you will find numericals in the paper, like the numericals will be like with calculate M1 or calculate M4 or calculate M3. These kind of basic numericals will be there. Once you understand the formula of all these, you will be easily able to answer the numericals. So in these sessions, we won't be practicing the numerical because these are the basic sessions. When we have the advanced question session, then we will practice the numerical, and trust me, it's a very simple chapter for the numericals. Now, second, let's talk about the inflation. What is inflation? Inflation is when the prices are rising continuously. When the prices of goods and services are continuously rising, that is known as your inflation. This is your inflation. It means rise in the prices. Clear? Now, why this is happening? So there are two causes of inflation. The first cause they have said, because the demand is more than supply, that's why prices are rising, and that's why inflation is there. And this have been named as demand pull inflation. It means when demand pulls the inflation, because demand is more comparative to the supply. That is your demand pull inflation. That's the first cause they have given us. The second cost is because the cost of production of your goods and services are rising, and that's why your prices are rising. And this have been named as cost push inflation. It means cost is pushing inflation in the country. What is cost? Cost means the expenditure you have to do to manufacture the goods, to manufacture the services. That is known as your cost. Okay, let's say if I am making this pen or the marker, the raw material I used here is plastic, the color, the ink, or I can say this printing, the wrapper on this marker we have wrapped on. This is all your raw material. And to purchase this plastic, to purchase this wrapper, to purchase this ink, I have spent certain amount of money, and I have combined them together. I have manufactured this particular what we can call it, the upper body of the marker, right? And for this I use machinery, I use labor or something. I have to do the transportation of this from one place to another, because let's say in India only Maharashtra is the state which is producing this marker. So obviously from Maharashtra we have to transport it from different locations, from two different locations, and that's a transportation cost. To manufacture this you have used electricity, to manufacture this you have used labor, to manufacture this you have used raw material, and all these are the part of your costing of the production. And when this cost increase, let's say the raw material prices increase, let's say the electricity charges increase, let's say transportation cost increase, let's say the labor's wages have been increased. In all these situations, your cost will be increasing. And when the cost increases, it increases the price. And that's your cost push inflation. So there are two causes of inflation that have been given. First is demand pull inflation, and second is we have cost push inflation. I hope it's clear. Apart from that, to measure inflation, like how much inflation is there in the country, we use certain indexes. That is wholesale price index, consumer price index, producer price index, and the index of industrial production. So all these we have to cover in the inflation chapter. Clear? So this is the basic understanding of both the chapters, that is your measure money supply and the inflation. Clear? Now let's move forward and start practicing the questions on the same topic. You will get more clarity of the concept. And before that, I will be your mentor for IE, IFS and PPB. And this IE, IFS session is going on Monday to Saturday, only on Officer Study 24/7 in the evening at 7 p.m. And the same Achiever Series session for PPB is going on in the morning at 6 a.m. Okay, so do make sure you join both the classes. So let's start with the first question. First question is asking about consumer price index measures prices at. So as I have told you, we have consumer price index, wholesale price index, producer price index, and index of industrial production. So when you see wholesale price index, the wholesale price index calculate the inflation at the wholesale level. What is wholesale level? Where the goods will be purchased at bulk level, and the prices will be comparatively less. And when the trading, the selling and purchasing happens between the entities, between the businesses, between the firms, that is your wholesale market. Individual persons like us, consumer, we are not participating in the wholesale market, and that will be calculated by wholesale price index. Now, producer price index will be calculating the producer level inflation. Okay, no such kind of index we have. If I talk about index of industrial production, it calculates inflation in multiple, or I can say various sector. In various sectors, it calculates inflation. It's a volume index. It measures how much production have been done. That's what the IIP is, Index of Industrial Production. So the right answer is CPI. At retail level, Consumer Price Index measures the prices. So right answer is your B. Okay, I hope clear. Next question. Next we have price index used in India to calculate inflation for policy formulation is. So to calculate or to form the policy for different purposes, like what should be done, how it should be done, what will be the next step of the government, because we know economic planning is very important. Simply taking decision for your taking major economic decisions in your economic planning, and that will be done when you know what's actually going on in the country. So first you calculate the wholesale price index, study the wholesale price index, what's going on at the wholesale market, and then you start formulating the policies. Okay, this is your right answer. So right answer will be C. Achha, apart from that, if I talk about monetary policy, so you all know about the monetary policy. Monetary policy formulated by Reserve Bank of India. And what RBI have done? RBI since 2014 adopted the consumer price index for the formulation of monetary policy. Do remember this. This is the add-on. Add-on means this is the additional or the reform happen in the policy formulation. Okay, so the policy, monetary policy formulation will be done by Reserve Bank of India, and it will be done on the basis of studying what actually going on in the consumer market. It means in the retail market. Okay, so this have been adopted by RBI since 2014. In 2014, RBI adopted this. Okay, so your right answer will be simply wholesale price index here, but for monetary policy it have been changed. Now it is CPI. So right answer is there, C. Next, which of the following statement is true about inflation? So inflation we have discussed, it is rise in the prices. And when this happen, when there is a more demand in comparison to the supply. So first is saying a rise in general level of prices is inflation. Second is saying leads to fall in purchasing power. And if we talk about inflation, inflation means whenever the money supply in the economy increases, people start demanding more goods and services. Because they have more money, they will demand more goods and services, and comparatively supply will decrease. Because I have told you so many times that the demand and supply have inverse relation. If one increases, the other one definitely will decreasing. So if demand is increasing, supply decrease, and it will increase the prices in the economy, and that's what the inflation is. This happens when inflation comes. Okay, after this, what happened when the prices are increasing? So you have to pay more money, and for more money you will get less goods and services. So you are paying more money to get less goods and services. It means your money value is decreasing. What is money value? The purchasing power or the purchasing capacity of money is known as simply your money value. So it is decreasing because your prices are rising. Let's say, for example, earlier I used to purchase these two markers in 200 rupees. Let's say, for example, but now I have to pay 200 for one marker. So I am paying more money and I am getting less commodity. In 200 rupees, I used to get two markers, but now I am only getting one marker. And that's what the value of money is decreasing. So it means the purchasing power will decrease. So right answer will be both A and B. So the general level of prices will increase. Second, your fall in purchasing power will be seen because the prices are increasing. Okay, so when you have to pay more money for less goods and services, it will do what? It will decrease the purchasing power of your money. The 200 rupees you have less value now. They are not purchasing 2 products, they are purchasing only 1 product. So right answer is C here. Now, demand deposits are, I think this is the simplest question you guys can answer. Hana, this is a very simple question. Everybody knows this. So demand deposits are what? They are paid on demand, obviously. So when we talk about banks, bank have certain assets and liability. When it comes to the bank have assets and liabilities. Clear? The liabilities of bank is public deposit. The liability of bank is what? It is public deposit. And deposits are divided into 2 parts. First is demand deposit and second is term, or you can call it a time deposit. So demand deposits is a type of accounts where a customer can deposit whenever the customer wants and the customer can withdraw whenever he or she wants. That's why it named as a demand deposit. Now, so it is paid on the demand of the customer. Now, in case of term deposit or time deposit, this will be fixed for a particular time. And that is your recurring account and fixed account. Or in general language, we use FD and RD for the same. Okay. So this is what we're talking about. So it's very obvious the demand deposit will be paid on the demand. And do remember this as well. Okay. So right answer we have is A. Next question. Next is saying that time deposits are, which of the following? Paid on demand? Obviously not, because it's a time deposit. Not paid on demand, relatively less liquid than the cash and demand deposit. So B to definitely is correct. It is not paid on demand. Is the C correct? And the answer is yes. C is also correct. The reason is because it's very obvious. The money you have in form of cash is the liquid form. The money you have in the demand deposit, it means CASA, that's also liquid in comparison to time deposit. Because whenever you want, you can withdraw that money. It can be used as a cash whenever you want the money you have deposited in the current account and savings account. It means right answer is D. So the time deposits are not paid on demand and they are less liquid related to the cash and the demand deposits. Right answer is D. It's a simple question again. Now, narrow money consists of. Now, I have told you what is narrow money. Let me know out of M0, M1, M2, M3, which of the following is a narrow money. Okay, apart from this narrow money, you have to define the formula of narrow money. So, narrow money is actually your M1. Do remember the formula I am writing here. CU plus DD plus deposit with RBI. Plus deposit with RBI. This is what? This is your M1. So M1 stands for narrow money and narrow money covers your first currency unit. CU stands for currency unit. That means notes and coins available with public. Second DD, that means demand deposit. It means CASA available with public. Then deposit with RBI. And you can see there is no time deposit I have written. So it cannot be C, it cannot be B. The third one is talking about currency with public and demand deposit, but it is not talking about the deposit with RBI. So it cannot be true. So right answer is A. The currency with public, notes or coins that we can represent with CU, currency unit. Then demand deposit, CASA, and then deposit with RBI. So your right answer is A. Do remember this formula. Now what kind of numericals will be asked on this topic now? So they will give you the value of these, the currency unit, the demand deposit and the deposit with RBI. The value have been given to you and they will ask calculate M1. So you just have to do what? You have to add all the three. Very simple. Now you can understand all the values will be given. Just you have to remember the formula and accordingly add all the values and it will answer you numerical. This is very simple. So your right answer is A. Okay, next. Money supply refers to. What is money supply? I have told you money supply is liquidity. What is money supply? Money supply is your liquidity. And when you talk about the liquidity, it means cash only. So the amount of money in banks, the amount of money with people, the amount of money in circulation in an economy, and that's true. That's the money supply. Because in the starting of the session, I have told you RBI have introduced measures of money. To do what? Simply to calculate the how much money is available in the economy. So it is the money supply which is available in the economy. The amount of money circulation in the economy. Right answer is C. Now, next question, we have the basic difference between narrow money and broad money. And you will be able to answer this when you know the formula of narrow money and broad money. So I have told you narrow money is M1 and broad money is M3. So now M1 I have told you it is CU plus demand deposit, or you can call it DD, and then the deposit with RBI. This is your formula of M1. Now what is M3? M3 is equals to M1 plus term deposit. Now I guess you can easily answer this question, because M1 is saying currency unit plus demand deposit with RBI, and M3 is saying M1 plus term deposit. So which of the following will be right? First is saying treatment of post office deposit. No. Treatment of savings deposit. No. Savings deposit are in both, because the DD is available in the M1. So demand deposit is here and here as well. Treatment of currency. No, it is available in both, but the term deposit, or you can call it a time deposit, it is not available in M1. It is available in M3. So the right answer will be B, the treatment of time deposit of bank. So the basic difference between narrow money and broad money is what? The treatment of time deposit of bank. That is B. Okay, this is the only difference. So do remember the formula. If you remember the formula, that's all you need. Now you will feel this is a very tough question, but it's a very easy question once you remember the formula again. So let's see which of the following is not rightly explained. Okay, not a true kind of answer you have to give here. First is saying M1 is currency with public, demand deposit of public, nothing else. So what about deposit with RBI? It means this is not correct. This is not rightly corrected or explained, I can say. M2 is saying M1 plus post office saving deposit. This is true. When you add post office savings deposit with M1, it creates your M2. M3 is M1 plus time deposit with public, that we have discussed. This is also true. M4 is M3 plus total post office deposit. This is not true. Why? Because it should required to write excluding national savings certificate. Now, why excluding national savings certificate? Because national savings certificate is Government of India security, and this security have a maturity period of 15 years. Okay, and when it comes to the 15 years, it's not liquid. You cannot use it as a cash, and that's why you have to exclude NSC from M4. It means that M4 is also not correct. M1 is narrow money, M3 is broad money, and the question was asking not rightly explained. It means first and fourth. It means your B option is the correct answer. The right answer will be your B option. I hope it's clear. Right answer is your what? It's B option. Okay, now next. Good evening everyone. Welcome to the official YouTube channel of Officer Sara 24/7. So first of all, let me know is audio video both are okay? Are we good to go? And in today's session, as you know, we have already started the Achiever series, and this is our next session for your Achiever series, in which we are discussing Module B of IEIFS. So as we know, every day we are discussing one particular unit of your IEIFS from Module B, because we have completed the Module A and started the Module B. So in today's session, the Module B class we are going to have is 5th class. That's your, I can say, if we talk about IEIFS subject, the Module B starts from the unit number 12 and it ends with the unit number 19. And if we are talking today about the 5th class, it means we are going to talk about the unit number 16. Okay, we are going to talk about what? We are going to talk about the unit number 16. Clear? So unit number 16 we have is your, okay, unit number 16 we have is your business cycle. So business cycle is the part of your Module B, and when it comes to the Module B, it is a very small module, but a little bit conceptual understanding is required in the Module B. So do make sure whenever you are reading Module B content, do read with the understanding of the concept. Do not try to mug up the things or the definitions in the Module B. So when it comes to the business cycle, Acha, before starting the session, first those candidates who are joining our session for the first time, I would like to inform them all that we are having these IFS Achiever series Monday to Saturday only on Officer Saturday 24/7 in the evening at 7 p.m. So do make sure you join these session on the regular basis, and if you haven't seen the earlier session, what you can do, you can watch the recording, because in the playlist all the sessions recording is already available. Okay. So let's continue here. If we talk about the business cycle, so as we do in every session, first we will understand the topic and then we will practice certain questions on this topic. So first of all, business cycle is a very simple topic. It's a very simple topic, trust me. If you cover this topic, it will take hardly 1.5 hour of yours, and in which you will be able to complete the concept and you will be able to practice the topic wise test as well. Both can be done, and definitely 2 marks question can be seen from here. So this is a very small topic, very interesting topic, very easy topic, and this is giving you how much marks? 2 marks. So do make sure you definitely cover this. Okay, now when I talk about business cycle, it's simply a cycle which have a wave-like movement. Wave-like movement, it means the situation or the phases of business cycle move like a wave. Okay, that's what the wave-like movement we're talking about. So actually the business cycle can also be known as an economic cycle, or you can call it a trade cycle. Trade cycle, economic cycle, business cycle, all are 3 same. Okay, in which we are checking like how the production capability or the production varies from one situation to another. It means if there is a fluctuations in the production as well as in situation of your economic activities, that fluctuation will be studied by the business cycle. It has 4 phases. The phase 1, we have peak, or you can call it a boom. Second, we have your recession. Third, we have your depression, and fourth, we have your recovery. So these are the 4 phases of business cycle that we have to study. They are also known as with the different names, but now in your chapter, in your book, these 4 names have been given: peak, recession, depression, and recovery. So peak, I guess you understood, it's a boom of your business, it's a boom of your economic activities, it's a boom of your production activity, and that's a peak. It means when the maximum production, the maximum customer base, the maximum growth of all the economic activities have been seen. That is known as your peak, or you can call it a boom. And the recession means when your economic activities start declining. Okay, it means the economic indicators start declining. That's your recession. Depression means those economic indicators became worst. Recession is also negative, depression is also negative, but recession comes when till 2 quarters there is a decline in the GDP was falling. That's a recession. And depression is the situation which is much more worse in comparison to your recession. And then there is a recovery. It means economy is trying to grow and economy is trying to come on its growth cycle for a particular period of time. That is known as your business cycle, and these are the 4 phases. Okay, so there are 4 phases of business cycle, trade cycle, economic cycle, whatever you want, you can call out of these 3 names. And do remember, apart from that, if we talk about this situation from recession to depression, this is a contraction. Each business cycle need 1 expansion and 1 contraction. Expansion means where the economic activities are growing, where the economic activities are increasing, where the economic indicators are growing. That is actually your expansion. And what is contraction? Contraction means where your economic activities are declining, where your production activities are declining, and this is the contraction. So I will show you here. This part is your expansion. This part is your expansion part, and this phase is your contraction phase. Okay, and no business cycle will be completed until and unless 1 expansion and 1 contraction in it. So both have to be there in the business cycle. Okay, Chalo. So let's continue. This is what you have to cover. So what actually you have to cover in business cycle? What is business cycle? Apart from that, you have to understand what are the characteristics, features of business cycle. Then the different 4 phases. You have to study like what are the characteristics of each and every phase of business cycle. Okay. So let's move forward and practice certain question that will give you more understanding of the topic. So first question is asking which of the following is characteristics of business cycle? The characteristic of business cycle you have to answer here. First is saying there can be no indefinite depression or eternal boom period. Second is saying business cycles are pervasive in their effect. Third is saying the up and down movements are not symmetric. And the fourth one is saying here all of the above. And you have to answer out of these 4 which of the following character is true. Achha, it is already showing you the answer. Okay. So the answer is obviously you have seen, and this is true, that there can be no indefinite depression and no eternal boom period. Second is also true, business cycles are pervasive in effect. It means business cycles effect will be very big. And if one industry is having the depression, it will spread to other industries as well. That's why we are saying that pervasive means very big. It affects at a very big level. Now next we have the up and down movements are not symmetrical. That is also true. So the right answer will be all of the above. Okay, all are the characteristics of your business cycle. Second question. That is asking about which of the following is a feature of business cycle. Now you have to answer which of the following is feature of business cycle. First is saying it's a regular phenomenon. Second is saying it's a predictable phenomenon. Third is saying it is a repetitive phenomenon. And fourth is saying none of these is correct. So let me know which of the following is correct. So if we talk about the feature of business cycle, do remember these 3 statements, that business cycle is not regular. Business cycle is not predictable. Business cycle is not repetitive. It means answer is none of these is correct. None of these statement is correct about the features of business cycle, because when you talk about business cycle, it is not regular. You cannot say that every year for 3 periods there will be, for 3 months there will be peak, for next 3 months there will be recession, for next 2 months there will be a depression, and therefore next 2 months there will be a recovery. You can't say that. It's not regular. It's not predictable. You cannot predict like when it, you cannot say in upcoming March we will be facing the recession. You can't say that. It is not predictable. It can be changed. The situation can be changed. It is uncertain. Then it is not a phenomenon. It's not a repetitive as well. Okay, so right answer, repetitive means in the sense it's not like this, these phases will not come again. They will come, but not in the same sequence. Like if I am saying January, not January, let's just start with the financial year, April, July, October. These are the 3 months. Let's say for example, here we have faced peak, here we have faced recession, and let's say here we have faced recovery. So it is not repetitive, means it's not like in the next, this was happened let's say in 2023, so you cannot say in the 2024 the same thing will be there. So it is not a repetitive phenomena. So right answer will be D. None of these are correct. Right answer is D. Okay, next question. Next is asking that the following are the major characteristics of which phase of business cycle. First is saying there is a general decline in demand as economic activity slow down. Second, inflation remains low or slows, further sign of failing. Third, employment falls, unemployment rises. Fourth, industries resort to rise to price cuts to stay in business. Out of these 4, what do you think these are the characteristics of which phase? So now you can easily understand. First is saying there is a general decline in demand. If there is a decline, it cannot be boom, obviously. Okay, because in boom, the demand will be rising. Second is saying that inflation remains low and or further signs of falling is there. It means your economy is more declining. Then employment falls and unemployment rises. So when unemployment falls and when employment falls and unemployment rises, this is the situation of what? It is the situation of recession, and industries have to cut their prices to stay in the business, because now the people are not demanding goods and services. And if the people are not demanding goods and services, you have to sell in a less prices so that you will be able to earn your money, or you will be able to survive in the market. So you will, whatever stock you have to make sure that a stock will be bought by the public, you have to reduce the prices, and that's why it is the recession period. So right answer will be B, recession. Okay, now next question we have here, pick the odd man out. Odd man out means the particular term out of these four which is not symmetric, like they are not from same context. We are not talking about the same context here. So you can see easily, slowdown is not from a same context, because boom, depression, recovery, all these are the phases of business cycle. So they are symmetric to each other, they are from the same context, but not the slowdown. Slowdown is not a phase. So right answer will be C. Next we have here, the business cycle is also known as entrepreneurial cycle, economic cycle, vicious cycle, none of the above. And when it comes to the business cycle, it's not the entrepreneurial cycle, not the vicious cycle, it is the economic cycle, or you can call it what? You can call it a trade cycle as well. You can call it a trade cycle, you can call it a economic cycle. Okay, so right answer will be your B. Next question. Next we have here, that which of the following statement is not correct regarding a business cycle? Not correct statement regarding a business cycle. First is saying various phases in business cycle are repeated. Second is saying there cannot be a decline. So you have to answer not a correct one. First is saying the various phases in the business cycle are repeated. Second, there cannot be definite boom or depression period. Third, business cycle are pervasive in their effect. Fourth, the upward movement is more sudden, violent than the downward movement. Now you have to answer which of the following here is not correct. So it is very true that the phases in business cycle are repeated. Boom will repeat again, the recession will repeat again. Then there cannot be definite boom and depression. This we have already seen in the first question, I think. Then it is also pervasive. This is very true, we have seen, but this is not true, because it's not the upward movement which is more sudden and more violent. It is the downward movement. So the statement should be like, the downward movement is more sudden and violent than the upward movement, but it is written inversely, or that's why the right answer will be your D option. Okay, right answer we have is D option. Next. So you can see it is saying a wave of prosperity or depression in one industry, in the case of a business cycle, will generate a wave in other industries soon. Which are the following feature of business cycle it represents? So I have told you, like, business cycle is a wave-like movement because it goes like that. But when it is saying a wave of prosperity and depression in one industries, in the case of a business cycle, it will generate a wave in the other two. It means what? If the textile market is facing recession, and because of that the other markets can also face the recession, and this is what the business cycle is synchronic. So if there is a prosperity or depression in one industry, it will impact the entire industry and the other industries also. And that's why we say now that business cycle have its effect in very big level. It's a pervasive in effect. We have studied that already as a feature of the business cycle. So right answer will be your B, that a business cycle is synchronic. It means if one industry is having a wave of prosperity or depression, it will be soon seen in the other industries too. Okay, B answer is correct. Next question. Which phase of business cycle is also known as a crisis? Now what is crisis? Crisis, now you can simply understand that the demand is declining. There is crisis, it means there is a high unemployment, and this will happen when there is no demand. And if there is no demand, it cannot be boom. Okay, it cannot be recovery. It can be either depression or recession, but the depression is the worst, or I can say when your economic activities stage reach to the lowest level, that's a depression. So the right answer will be recession. So the crisis period of business cycle is your recession. Okay, it is what? It is your recession. So the right answer will be D. Clear? So, acha, what is the difference between recession and depression then? Hana, a lot of people ask this situation. Like they both look like same. No, they are not same. When the GDP of your country declines continuously for 2 quarters, it creates recession. It creates what? Recession. And what happens in recession? First, in the recession, the corporate's demand, was not the demand, actually the earning, will start declining. It means company will start earning less amount of money. And because of that, because the corporate's earning is declining, what happened next? The unemployment increases. If the corporate is not earning the sufficient amount of money, it will start firing the people, so unemployment rises, and because of that your wages will decrease. And when this starts happening for 2 quarters, that is known as recession. When this recession and these things continues, with that you can see your GDP is obviously declining, your unemployment is obviously increasing. Okay, your per capita income started declining, your national income started declining, your economic growth started declining, and they reach to the lowest point. They reach to their lowest point. Like in recession, they started declining, but that was not lowest. So I can say the worst situation of recession, when recession itself becomes the worst, so at the worst level, that is known as depression. Okay, that's the difference. So see, whenever economy is declining, now let's say this is your phase. Now whenever economy start declining from here, it first face deflation, then it face recession. Okay, then it face depression. So all the three are on the same context, like they are in the situation when the economy having a contraction, when economy is declining. But the level of declining, the level of losses will be different in deflation, in recession, and depression. Okay, so right answer here is this D, that recession is also known as the crisis. Next. The underemployment of both men and material is characteristic of which phase? Now, I guess unemployment everybody knows. What is unemployment? Unemployment simply means when, what we can call it? Unemployment simply a way in which you can find that the person who is physically and mentally capable of working, the person who is willing to work, the person who is skilled to do a work, and the person who is looking for a job. All these 4 activities are done by the person who is looking for a job. He is skilled, he is physically, mentally fit, he is looking for a job but is still not able to find one. That situation is known as your unemployment. Okay, so but here we have a underemployment. What is underemployment? So unemployment means you are willing to work, you are skilled, you are physically fit, you are mentally fit, you are looking for a job but still you are not getting a job. That's an unemployment. And underemployment means you got the job but you have to somehow lower your, what we can call, level. Like you deserve the much better job, you deserve the money in a job that should be more, which you are getting right now, but you have to settle down for a less. That's the situation, is underemployment. And this happens when there is a depression. Like for example, if you remember after COVID, so at the time of COVID, the lockdown was there and a lot of people have lost their jobs, and those who were having jobs, they were working at a less salary, or we can say the salary was not less but they are not getting paid on the time. These kind of situations were there. And when the economic lockdown have been removed and people started working, so obviously we have seen that people have to settle down for the less, because the companies know, the market knows they do not have a job, they will agree to work in a less amount of salary, and that's what is the depression. So in the depression, underemployment will be seen, like the men and material both have to settle down for less what they actually belongs to. Okay, so the right answer will be your A. This is the characteristics of depression. Next, which of the following is not a feature of a recession? First, the demand exceeds the supply. Second, future investment plans are put on hold. Third, workers are retrenched. Producers are forced to reduce the price. So I have told you the unemployment will increase. So workers are retrenched. This is very much true. It's a characteristic of recession. Then they have to reduce the prices because people do not have money, they do not have job, they do not asking for more goods and services. So you have to reduce your prices so that whatever stock you have, that will be bought by the public. Then it is also true that in the time of recession, you have lost your job or your wages have been reduced. In that situation, you have to somehow settle for future investment, like you have to hold your investment plans. Like I was thinking before the COVID, let's for example, before COVID, I was thinking let's start our own coaching, Hana, let's say for example. And in that situation, what happened? Me and my friends have decided we will start our own venture and etc. and etc. But then COVID happened. And after COVID, we haven't taken, or obviously at the time of COVID, we haven't continued with our plan. Reason? Because let's say for example, we have decided this is the location where we open the office, the branch or whatever. And these are the faculties we are going to hire. But at the time of COVID, everything was shut. And in that situation, we have to hold our future plans. Hana, now we said no, we are not going to open now because might be this is one day Janta curfew, but might be it can increase by the government because COVID was such a deadly virus. And in that situation, we hold our future plan that after this lockdown will be removed, or then we will think about it. So this is what you have to do. This is also a feature, but A is not a feature. The demand exceeds the supply. No, in this situation, the demand will decrease and supply will exceed, because you already have produced goods in the market, but the people do not have money. That's why your supply will be more than demand. So right answer is A. Okay. Good evening, everyone. Welcome to the official YouTube channel of Officer Study 24/7. So first of all, let me know how are you all, and also let me know is audio video both are okay. Are we good to go? So as you know, we have started this achiever series. Every day we are discussing one particular unit. So first of all, starting with the one particular unit. And we have started your module B. So as you know, in IFS we have 45 units. Out of those 45 units, we have 11 units in module A. From 12th to 19th unit, we have module B. And from 20th to 45th unit, you have module C and D. So it's very obvious C and D have a more syllabus, more content to study. So they have more weightage in the paper as well. So we will be covering the module B like we have done in the module A. First, we will cover one day, one unit, and then we will have an advanced questions on the same module, and then we will move forward to the module C. The same will be done with the C and then the D. So this is how we are going to cover our whole syllabus of JAIIB, IFS from module A to module D. Now apart from that, if we talk about the IFS subject, so it's very obvious that a subject is new for all of you, but once you have understood what are the things that have to be done, like if you understood what smart work have to be done, definitely you will be clearing this paper. Okay, but yes, before that, this is what I want to tell you all before we move forward with the session. This is what I want to tell you all, that is Happy New Year, everyone. Happy New Year to all of you. This is 1st of January, or I guess all of you have taken your resolution. Like on this year, I will be doing that and I will be doing this. It's good to have the resolution and it's very good to follow them. So do make sure you take the resolutions for your personal life, but yes, also take certain resolution for your professional life. Make your career much better in this particular year by clearing the JAIIB and CIB both together in the same year. And it is really, it is possible. It's not like I'm telling you something that is impossible to do. No, It is definitely possible if you manage your timing, and if you give 4 hours daily to each subject of your, 1 hour daily to each subject of your, it means total 4 hours if you are giving, then trust me, it is definitely possible to clear the JIB in one attempt, and in the November, December, you can clear the CIB as well. And on this journey of for your professional resolution or for your career growth, we all are here and we have taken resolution already. I guess you all know about this. But yes, if you haven't knew about this, I will let you know in the end of the session, and this is the biggest surprise for all of you, so be connected till the end of the session. So let's start the session now. In today's session, I will be covering your module B, class number 4. That will cover your unit number 15 of module B, and that unit is theories of interest. So on this start of the new year, we are starting with the very tough topic. Now, why I am saying very tough topic, it's not like it's not able to understood. The topic is so tough that we won't be able to understand this topic, and we won't be capable of answering the question. No, this is not such kind of thing is there. Comparatively, the whole syllabus of your IE IFS is one side and the theories of interest is one side. So it needs more time to understand the topic, because in this we have to cover the concepts regarding interest. Then we have to cover the ISLM curve, that is investment, savings, liquidity preference and money supply curve. Then we have to cover the certain school of thoughts like classical theory, Keynesian theories we have to cover. And that definitely will be taking a little time to understand the concept, because I know those people who do not have their background economics, they will face the problem in this particular topic. So I would say do check the questions of this particular topic today, and once you have completed the conceptual study of the same topic, again repeat this session, check this session and answer the questions. So it's very important. We cannot cover theory right now, or we cannot cover theory on the YouTube, because we are not covering that. We are following the MCQ, most important MCQ sessions. We will be doing that only today. But yes, 2 to 3 hours have to be given to this particular chapter to understand very clearly and answer the question. And trust me, one question definitely will be seen from here. And if you feel like for one question that much hard work we have to do, no. Yes, you have to do. If you want to drop this chapter, don't do that, because this is very important chapter. Okay, so let's start. If we talk about the theories of interest, first of all, what is interest? Interest is the payment that the borrower made to the person or to the bank or to the financial institution from wherever the borrower have taken loan. If I'm taking certain amount of money from certain person or certain institution, I have to make them payment, and that payment I have to make in form of interest. It's very obvious that I have to pay, I have to give back the principal amount, but principal amount is what I have taken from the same person. Now, so what actually I am paying to that person? I am paying that person the interest. So what is interest? Interest is the payment that have to be paid by the borrower on the sum of money or the sum of amount that he or she have taken from someone or some institution for a particular period of time. That's your interest. And when it comes to the interest, there are 3 elements of interest which decides what rate of interest you have to charge on the money. The first one is risk involved in providing loan to someone else. If you give your money to someone else to use for a particular period of time, it always involves the risk. A basic risk will always be there. Doesn't matter you are giving loan to Mr. Ambani, Mr. Modi, Mr. Tata or whatever. And it doesn't matter. If you are giving loan to someone, the well-established person, the well-established industry, still it have basic interest involved. So the first element is the risk involved in providing funds. Second, the trouble involved in providing funds. When you are giving some of amount of money to someone from your income, from your money, from your savings, from your surplus of money, that some trouble will be involved in that. Like you have to go to the bank, you have to withdraw the money, you have to stand in the queue, then you will withdraw in the money, then you have to give money to someone, whatever trouble you are facing. Or if that customer or that person is not repaying the loan on the time, it means somehow you are facing problem there also. So whatever trouble is involved, that have to be calculated. And the third and very important element is pure interest. Now, what is pure interest? It's very obvious. If I have this amount of money additional, I'm not using that money. For present, I do not need this money, but this is my earning. In future, might be I'm using this money. So for particular period of time, I can deposit this money in savings account. I can deposit that money in the term deposit FD or RD. I can invest that money in the mutual fund. I can invest that money in the share market, and I will be earning certain amount of money on that sum of money, obviously, right? But I'm not doing that. I'm just giving that money to someone else. So I deserve a certain rate of interest that will compensate the investment I will be doing, or I will done and with my money that I'm not doing because I'm giving you the money. So that amount of money that you deserve on your money, that amount of interest that you deserve on the sum of money you are giving to someone else is your pure interest. So these are the three elements of interest on the basis of what we have decided, or we decide what rate of interest should be charged. Okay. Now next, so let's start with the MCQs. We will be discussing MCQ. The more concepts will be clear to you. Okay, and do remember this chapter will only be understood to you properly when you have done the conceptual study. So do make sure you cover this chapter with the conceptual understanding. So the first question we have here is, if the money supply, right? If the money supply is increased by government in economy, then interest rate goes down, goes up, no effect, all of the above. So what is we are talking about? The money supply is increased by government in economy. So government have increased the liquidity, the money supply in the economy. In that situation, the interest rate will be what? Going down, going up, no effect, all of the above. And your right answer for this particular question will be A, that is goes down. Okay, your rate of interest will goes down, then only you will be able to increase the money supply in the economy. Now, so the right answer will be A option. Okay. Now, the second question we have, position of money demand curve depends upon which of the following? So if I will be only talking about the demand curve. So what is demand curve? Which gives us the relation between the price and quantity demanded, right? So if I'm talking about the demand curve, I will be deciding, or I will be telling you what's the relation between that. But now we do not have demand curve. We have money demand curve. So position of money demand curve depends on what? The nominal income, the interest rate, both A and B, and none of the above. A, B, C, or D. Which of the following is correct? Okay, and the right answer of your will be correct, both A and B. So position of money demand curve depends upon what? Both A and B money. That means the nominal income and interest rate. So right answer will be your C. Next question we have, analysis of the short and long runs indicates that the dash assumption are most appropriate in dash. So I have told you we have two theories, classical theory. We have schools of thoughts, that is classical school of thoughts and Keynesian school of thought. The Keynesians is actually the theory that have been given by Mr. J.M. Keynes. And J.M. Keynes, we all know, Mr. John Maynard Keynes, father of macroeconomics, and he have also given us the definition of national income, right? So the question is asking, like, analysis of the short and long run indicates. What indicates? That dash assumption are most appropriate in dash situation. Now what we are talking about, is it classical assumptions are most appropriate in both short and long? No, it cannot be best or most appropriated in both the runs. Not possible. So the A and B cannot be true, because it's saying both short and long run are most appropriate. No, most appropriate means one will be the most. Now third is saying classical assumption are most appropriate in the short run. No, the classical assumption are most appropriate in long run. It means right answer is D. So when you study the classical theory and Keynesian theory, you will understand this. But yes, do remember, when you study the long run and short run indicates what? It means you are studying your economy for a shorter period of time and for a longer period of time. And according to Keynesian assumption, it has been said that the short run is the most appropriate. and the classical assumption says that the long run is most appropriate. So obviously now every economist have their own view of studying the things. Like we have discussed that 4 definitions have been given: wealth definition, welfare definition, growth definition, scarcity definition of your economics. Because the 4 economists have given their view on what is economics. Accordingly, the Keynesian school of thoughts and classical school of thoughts have given their thoughts, like after their study, what they have find out about the economy, that they have given us here. And that's what the option D is saying. So according to Keynesian theory, the assumption of Keynesian theory are most appropriate in short run, and in classical, the most appropriate in long run. So right answer is D. Okay, right answer will be your D option. Next, if the short run ISLM stand for investment, savings and liquidity, preference and money supply. Okay, equilibrium means equality. They both came to the same level. Occurs at a level of income above the natural rate of output. In the long run, the dash will dash in order to return output to the natural rate. So what happened? Your level of income is above the natural rate of output because ISLM, short run ISLM equilibrium occurs. So because in the short run, your investment, savings, liquidity, preference and money supply curve became equilibrium. In that situation, your level of income became above the natural rate of output that should be there. So what happened in long run? In long run, when the price will increase, in the long run, price will what? Increase to do what? To order to return output to the natural rate. Obviously, to come to the natural rate, what happened? Like this is the situation of inflation. And let's say this is the situation of when the demand equals to supply. And you became at the stable situation. So what you have to do, you have to make sure that either the demand will be more than supply or the supply will be more than demand as per the economic situation. So here we are saying the level of income is above the natural rate of output. It means the prices are high now. If you have 100 goods and that 100 goods belongs to 1,000 rupee of earning and you are getting 2,000 rupee, it means the prices are increasing. So what you have to do, you have to increase the price that will return output to the natural rate. So right answer will be A option. Okay, right answer will be your A option. Clear? Next, pure interest is dash. Now what is pure interest? So I have told you interest have 3 elements on the basis of what we decide what will be done. Okay, and now what is pure interest? First is saying payment for use of money. Second is saying payment for risk involved in making loan. Third is saying payment for trouble involved for making loan. And fourth is saying none of the above. So what do you think? Which of the following is correct? So pure interest is the payment for use of money. The money I have given to someone for utilization, and on that money, whatever basic rate of interest is going on, whatever basic earning I would be having, that is my what? Pure interest. So pure interest is what? Payment for use of money. Right answer is A. Okay, next question. If the bond price goes up, then the interest rate comes what? Do remember the bond price and the interest rate, they both have what? They both have inverse relation. And if it is inverse relation, bond price goes up, then your interest rate goes down. So right answer is C. Okay, your right answer will be what? C. The interest rate will go down. Okay, next question. Next we have at higher rate of interest, the holder of money will invest in bond or hold cash in hand. So when the interest rates are higher, what you will do? You will hold the cash with you or you will invest in the bond. Or you can do both in the certain ratio like 50-50, 60-40, whatever you feel right, or none of the above. So what should be done at the higher rate of interest? Holder of money, that means the person who have surplus money, will invest in bond or will hold in cash. So it's very obvious holding in cash is not the right decision at the time when you have more interest rate. You will do what? You will invest in the bond. You will do what? You will invest in the bonds. The right answer will be B. Okay. Next we have where IS and LM curve intersect at the point or the money supply is equal to the money demanded and savings are equal to what? The interest, the income, the investment, the rate of interest. So I have told you IS stand for investment savings, LM stand for liquidity preference and money supply. So when these both curve intersect at the same point, है so money supply equals to your money demanded. So what happens? Savings will be equal to your investment. What you are demanding, you are getting. That's the money supply equals to money demand. And whatever is your saving, it will be whatever you are investing. So the right answer will be C. Savings are equal to what? They are equal to your investment. So right answer will be your C option. Okay, next question we have IS stand for. So many times I have told you in today's session only, what is the full form of IS? Investment salary, investment source, investment sample, investment savings. And the right answer here is simply investment savings. Correct. The D answer is correct. Very much correct. Right answer is D. Okay. Next, the variable that links the market for goods and service and the market for real money balances in the ISLM model is the dash. Is it what? Let me know. So which of the following is correct? We are talking about, it is obviously for interest rate. So the variable that links the market for goods and services and the market for real money balances in the ISLM model is what? It is the variable interest rate. So right answer will be B. Okay. Next, the initial LM stand for liquidity model, liquidity preference and money supply, liquidity and money model, liquidity and money. And I have told you many times it is liquidity preference and money supply. So this is the right answer. That's the B. Okay. Now, author of the book General Theory of Employment, Interest and Money is, who have written this book? And the name of authors are Mr. Adam Smith, Mr. Leonan Robbins, Mr. J.M. Keynes, none of the above. And the right answer is Mr. John Maynard Keynes, who is known as the father of macroeconomics, who have given us the national income definition. He has written the book General Theory of Employment, Interest and Money. So your right answer will be C. This is a very important book. One-liner question can be asked on this book. So do remember who have written this. Mr. J.M. Keynes have written this. John Maynard Keynes have written this. Okay, so right answer is your C. Good evening, everyone. Welcome to the official YouTube channel of Officer Study 24/7. How are you all? So welcome to the channel. And before starting the session, before moving forward, first let me know is audio, video both are okay? Are we good to go? So in today's session, we will be discussing about the module B, class number 6. That is your IE/IFS. So as we have already discussed that when we talk about IE/IFS subject, there are total 45 units. How many units are there? We have 45 units in this particular subject, and each unit have divided in 4 of your modules. Like it means we have 4 modules, and if we talk about the 4 modules, we have 45 units in the 4 modules, and that we have to cover here. So before moving forward, first let me know is audio, video both are okay? Are we good to go? And also one more important thing. What's happening? Okay. Yeah. So if we talk about IE/IFS subject, as you all know that we have discussed, just give me a minute. Okay, so as we have discussed that there are 4 modules, and in 4 modules we have 45 units that we have to cover in the IE IFS subject. And when it comes to this subject, the 2 modules IE covers A and B module of your, and the module C and D is a part of your IFS. And out of that, module A we have discussed in your YouTube series. In the Achiever series we have already covered your module A, and today we are going through the module B. Already module B 6 classes. This is the 6th class of module B. So if you haven't seen earlier session, do make sure you check on the playlist. You will find all the sessions available there. Okay, so let's start. And if we talk about today's session will be our monetary policy and fiscal policy. That is unit number 17. Overall, if we talk about unit number, it is the 17th unit number under the module B. So we have module A, in which 11 units are there. From unit number 12, we have your module B. Okay, and when it comes to the module B, we have to cover the kind of topics which are related to the banking, but they are of economics topic, like the monetary policy, fiscal policy we are talking about. When we talk about monetary policy, first of all, the basic I will write here about these 2 topics. Monetary policy is actually prepared or formulated by Reserve Bank of India. Who makes monetary policy? RBI makes monetary policy. And when we talk about the review of monetary policy, it's a bi-monthly review. When we talk about bi-monthly, it means every 2 months RBI gives us the review of monetary policy. Okay, so when we talk about monetary policy, it is what? It is formulated by Reserve Bank of India. It provides us bi-monthly review. Bi-monthly review means it's simple. Every 2 months there will be review of monetary policy, and it will be in one financial year you will get 6 reviews of monetary policy. Okay, apart from that, if we talk about further, you can see in the monetary policy, the main objective to make monetary policy is to make sure that there is a price stability in the market. Okay, in the economy, there should be the price stability. That's the objective of Reserve Bank of India behind making the monetary policy. So by controlling money supply in the market, RBI tries to control the prices in the economy, and that's the main objective of monetary policy. When it comes to the other objective, to maintain price stability, RBI have to make sure that there is no compromise with the sustainable economic growth of the country. It means prices have to be managed by RBI, price stability should be there, plus apart from that, there should be the proper, if we talk about the economic growth, it means there should be no compromise with the economic growth. Price stability with the economic growth is mandatory. Okay, price stability with the economic growth is mandatory in the economy, and that's why RBI makes the monetary policy. This is the main objective. Now, when it comes to the fiscal policy actually formulated by Ministry of Finance, that means Government of India. And when we talk about fiscal policy, it is Government of India's policy in which the review will be provided annually, and this is actually our budget. There will be annual review, or we can call it the budget. So fiscal policy is actually the budget of Government of India that talks about the upcoming financial year's revenue and expenses. Like what will be the revenue for the upcoming financial year of Government of India and what will be the expenditure. So in the fiscal policy, we are actually making our budget related to your Government of India. Like what will be the earning in the upcoming financial year and what will be the expenditure in the upcoming financial year. That's talked about under the fiscal policy. Now, when it comes to the fiscal policy, the instrument that government use here is tax and the spending of Government of India. Okay, tax and spending of Government of India is actually the fiscal policy of Government of India, or instrument of fiscal policy. So whenever government formulates fiscal policy, that is every year have to be done, because every year the budget have to be introduced. This is what we're talking about here. Okay, so fiscal policy is simply a policy that will be formulated by Ministry of Finance under the Government of India, obviously. Annual review, it means the budget will come once in a year and that will be presented on 1st of February. So this is the monetary policy prepared by RBI. This is the fiscal policy prepared by Government of India. And on this topic, we have to discuss the certain number of questions. So let's start with the first question here. The first question is talking about FRBM Act enacted as law in which year? So also you have to remember the full form of FRBM. So I won't be letting you know here the full form of FRBM, because one question I have added in this session that will talk about your FRBM only. Okay, so FRBM is Fiscal Responsibility and Budget Management Act, and this act was actually, you have to remember 3 years regarding this act. So in 2000 year, this bill was first time introduced, and this was introduced by Mr. Yashwant Sinha. Mr. Yashwant Sinha was the finance minister at that time, and he actually introduced this budget. Then in 2003, this bill was passed and this act was created. Okay, so this act was passed. In 2004, this act became effective. This act became effective in 2004. Clear? So this is the 3 years we have to remember. All the 3 years you have to remember. Like the first, when we talk about 2000, it was the year when the act was introduced. Second, 2003. Sorry, in the 2000 year, the bill was introduced by Mr. Yashwant Sinha. In 2003, the parliament passed the bill and it have been converted to act. And in 2004, this act became effective. But the question is asking, FRBM Act enacted as law in which year? In 2003. It means the right answer will be your B option. The right answer will be your B option. That is 2003. I hope clear. Now, the next question we are talking about here is fiscal policy India is formulated by. And that's a very simple question we have just discussed. Fiscal policy is Government of India's policy, and it is actually formulated by the Finance Ministry. It means C option. Who maintains, who formulates the fiscal policy? Ministry of Finance formulates the fiscal policy. Your right answer will be C. Okay. So, fiscal policy in India formulated by Finance Ministry, Government of India. Okay, and always remember the budget will be presented by the finance minister only. So right answer will be your C, that is Finance Ministry. Next question we have, which of the following items are included in revenue receipts? So when we talk about revenue receipts, before going through the revenue receipts, let's understand the basics here. When we talk about the budget have two receipts, or we can say budget have two components. The first component of budget is revenue budget. The first component of budget is revenue budget, and the second component of budget is capital budget. So when we talk about the revenue budget, what is actually the revenue budget? Revenue budget is the budget which is day-to-day budget. It means daily budget, daily government's income and expenditure will be talked under the revenue budget. And when it comes to the capital budget is the budget which is a long-term budget. Long-term income and expenditure will be calculated here. So budgets have two types, revenue budget and capital budget. Revenue budget is day-to-day budget, capital budget is a long-term budget. Now, both the budgets, obviously budget is always a statement of revenue and expenses of Government of India. So this revenue and expenses will be divided into two parts. Okay, so the revenue budget and capital budget have two parts. First part will be revenue receipts and second revenue expenditure. Here capital receipts and capital expenditure will be there. And when it comes to revenue receipts, it means what? It means the day-to-day income of Government of India. Because revenue budget is a short-term budget, and when we talk about day-to-day income of Government of India, it is known as your revenue receipts. Clear? So your right answer will be what? First is saying tax revenue, and this is true. Every day we are purchasing something from Government of India, and every day we are paying taxes. So tax revenue is a day-to-day income. Second, non-tax revenue. It is also a day-to-day income. Let's say, for example, we are going for a we are going for a long drive. Okay, and we forgot to have pick the seat belt. In that situation, we have to pay to the traffic police the challan or fine or penalty, whatever. So these fine and penalty challans are day-to-day income of Government of India. That is also true. Recovery of loans. When it comes to the loans, it's a long-term earning for the government. And the borrowing and other liabilities also long-term. So these two are the part of capital. But A and B, it means first and second is the part of your revenue receipt. So the right answer will be your A, first and second. Okay, so right answer is A, that is first and second. Next question. So next question is bank rate is also referred to. So what is the other name of the bank rate? You let me know that. I will let you know here what actually the bank rate is. So we know under the bank rate, RBI actually give loan. RBI give loan to whom? To the scheduled commercial bank. RBI gives loan to scheduled commercial bank for long-term period. Long-term period means for more than 3 months. So whenever RBI gives loan to commercial banks for the long-term period, that is known as your bank rate. This is known as your what? Bank rate. And when it comes to the bank rate, okay, right now as of today, it means as of 3rd of January 2024, right now we have a 6.75% bank rate. But as I have told you, bank rate is the indirect instrument of monetary policy, but every 2 months this monetary policy will be reviewed. And now after January, the next review or the last review of the financial year 23-24 will be February. So in the one financial year we have 6 reviews, and this review will be the last review. The February review will be the last review of financial year 23-24, and after February the next review will be seen in the year in the month April 2024. Okay, and you guys have to remember the rates of policy rates and your reverse ratio. You have to remember of April month, because you have paper in May and the latest one will be your April. Okay, so now here this is current and we have to read about the latest one, that will be in April. And RBI gives loan to whom? To the scheduled commercial bank for the long term period more than 3 months. That is known as bank rate. And the other name of bank rate is discount rate. Okay, the other name of bank rate is what? The discount rate. So the right answer will be your A. Clear? Next question. Expand FRBM Act that was introduced in the year 2003 and became effective in 2004. So what is the full form of FRBM? The full form of FRBM is simply Fiscal Responsibility and Budget Management Act. This is the FRBM. Fiscal Responsibility and Budget Management Act is the full form of FRBM that was created in the year 2003 to maintain. And why this FRBM Act was introduced? To make revenue deficit 0 and fiscal deficit 3%. This is the target of FRBM Act that have been taken, but still we are not able to achieve this target. Still we are having the same target, that revenue deficit should be 0 and fiscal deficit should be 3%. Okay, next question. Next question we have here is expand OMO. What is OMO? So OMO is actually the indirect instrument of monetary policy, and what OMO is I will let you know. You let me know the full form of OMO. So first of all, when we talk about OMO, here Government of India issues its security. Government will give its securities to RBI. And whenever RBI feels that scheduled commercial bank have access liquidity, more money is there with the scheduled commercial bank, what they will do? They will give loan to the public. So that's why RBI have to reduce their liquidity. So RBI will sell security to the scheduled commercial bank and will take liquidity from them. Okay, but these securities will always have a maturity period. Like treasury bills have 91 days, 182 days, 364 days. If we talk about your dated government security, you have a maturity period of 1 year to 40 years. In case of your, let's say, cash management bill, up to 90 days. So every particular security have a maturity period. So as and when the security's maturity will be ended, RBI will purchase back the security and will give liquidity to the scheduled commercial bank. So whenever RBI have to maintain the liquidity of scheduled commercial bank, then government issues securities and give to RBI, and RBI use that security to maintain the liquidity of scheduled commercial bank. And this is done under the open market operation. It means the A option. And one more important thing is that in open market operation, there is no participation of public. Public cannot directly participate in the open market operation. Clear? So here right answer is A. Next question. Next question we have, if RBI wants to reduce liquidity from the system, it should. Like if RBI want to reduce the liquidity from the system, what should RBI do? First, decrease the reverse repo rate. Second, decrease the repo rate. Third, increase the CRR. Four, decrease the SLR. So first of all, RBI want to reduce liquidity. Now, if RBI wants that the money should be less in the economy, what have to be done? RBI have to increase the policy rates. When RBI increase policy rates, then what happened? The loan will become costlier. The loan will be costlier for the public, and when the loan will be costlier, the money supply with public will automatically reduces. Okay, so what happened? What have to be done? RBI have to decrease reverse repo rate, decrease repo rate, decrease SLR. No, RBI have to increase the CRR. It means C option is correct. Because when you increase the policy rates of monetary policy, then the loan become costlier, and then the money supply will automatically be controlled. So right answer is C. Okay, next question. Which of the following statements accurately describe an expansionary monetary policy? So expansionary monetary policy is also known as a easy monetary policy, and this happens when RBI want to increase the money supply in the market. So whenever RBI want to increase the money supply in the market, one second, what RBI have to do? RBI have to reduce the policy rate. When policy rates will be reduced by RBI, what happen? The loans will become cheaper. Loans will be cheaper for the public, and it will increase the money supply in the market. So this is the effect that will be seen whenever RBI makes expansionary monetary policy. So first is saying it decrease the total money supply. No, it is increasing the money supply. First cannot be correct. Second is saying it raises interest rate. No, in the expansionary monetary policy, interest rate will be decreased. Okay, it will increase unemployment. No, if the money is more with the public, they will demand more goods and services, and if they are demanding more goods and services, what happened? They will be seeing more demand of goods and services from the public. Then the production have to be increased, and for production you have to give job, and it is saying it increase employment. No, it will increase the employment. So right answer is D. It increase the total supply of money in the economy. So right answer will be D. Okay, so what happen if RBI makes expansionary monetary policy? It will increase the total supply of money in the economy. Right answer is D. Next question. Next we have, as per the amendment RBI Act, what is the inflation target set by the government of India for the period from 1st April 2021 to 31st of March 2026 with the upper lower tolerance limit? So in the Monetary Policy Committee, this work have been given to Government of India, that the Government of India have to take the target of inflation for what years? For 5 years after consultation with the RBI governor. So the inflation target will be taken for 5 years by the government, but after consulting with Reserve Bank of India. And right now from 1st April 2021 to 31st March 2026, we have the inflation rate is 4%, upper tolerance limit is 6, and lower tolerance limit is 2. So we have 4% plus minus 2%. This is the inflation target. So right answer will be your B. Right answer is B. Okay, next. Next we have, which of the following is a development that can occur as a result of deficit financing? It is a development that can occur as a result of deficit financing. So deficit financing is a function that is performed by RBI for the Government of India. So under this, whenever Government of India have a temporary mismatch of inflation, or I can say the temporary mismatch is there of what? When there is a temporary mismatch of your income and expenditure of Government of India, at that time RBI will print more currency on the order of Government of India. That's the deficit financing, and it actually what result will be seen? The rise in inflation within the Indian economy. That's true, because more money you are printing there. Second, the improvement in the money supply in the economy increases, and that's also happens. Money supply will be improved in the economy. The increase in government debt, that is also true. Government will have to borrow money from RBI, so increase in debt have to be done. So right answer will be all of the above. All of the above are the result that will be seen when there is a deficit financing. So right answer is D. Good evening, everyone. Welcome to the official YouTube channel of Officer Saturday 24/7. So first of all, let me know how are you all. Also, let me know is audio, video both are okay. Are we good to go? So let's start the session. Every day we are discussing one particular unit from Module B. So if we talk about IE IFS, it have 45 units. Out of 45 units, 11 units are there in Module A. Then around 8 units are there in Module B. So we have done with the Module A. We have also done the advanced questions of Module A. Then we have started Module B. We have done with the Module B individual session. So in today's session, the next topic we will talking, it means the individual topic we are talking about here about the Module B. So you can see it is the 7th class of Module B. Okay, and in this particular class we will be talking about the unit number 18, that is System of National Accounts and GDP concept. So there are, as I've told you, there are 8 units in Module B, and when it comes to the Module B class number 12, it means unit number 12 to 19. These are the units we have in the Module B. Okay, 12 to 19. And today, as you can see, we are discussing 18. So tomorrow we will be doing the 19th unit. And this is how the Module A topic wise practice have been done by us on YouTube. Okay, apart from that, as we have completed all the units, like from 12 to 19 units we have completed, then we will be doing certain advanced questions on the same units. It means on Module B we will be practicing certain advanced questions on the session. Okay, after tomorrow's session, it means on Saturday, Hana? On Saturday, we will be having the session in which we will be talking about the advanced questions from Module B, the combined unit from 12 to 19. Combined unit advanced questions will be done on Saturday. Okay, so do make sure before Saturday you will see all the individual sessions of Module B on Officer Saturday 24/7. So if you haven't seen till now the other classes, the recording of the classes are available on the YouTube in the playlist. Hana, just go to the Officer Saturday 24/7, go to the playlist section. The playlist will be available for all of you, and it's updates time to time so that you will get the latest videos as well. Okay, so let's start. As you can see, today's topic we have System of National Account and GDP concepts. When we talk about System of National Account, it's a kind of a standard way. It's a standard way to define your statistical data, to define your economic data in a way that it is easy to compare with the other countries. So we know, as we are one of the emerging nations in the world, emerging country in the world, or as IMF said that India is the fastest growing economy in the world. All the other countries will be compared, or India's growth will be compared with the other countries. And for this comparison, to know which country is at the top 5 level, which country is at the top 3 level, we have to compare the statistical data of each and every country. And for that, we have made a standard way by which we are comparing the data, and that is known as your System of National Account. Okay, so it is a standard way to compare your what we can call it. It is the standard way to compare all your details or your data, etc. about the economic growth and economic development. Okay, apart from that, if we talk about GDP concepts, when we have to study the GDP concept, it's not like just you have to know what is GDP and how to calculate the GDP. This is not sufficient. When you are studying GDP, you have to cover the national income, the per capita income, the GDP, the GNP, the NDP, and the NNP. All these have to be covered to understand the overall GDP concepts. Apart from that, gross value added, GVA, is also a concept there. Apart from that, we have to cover the different calculations of these products, like gross domestic product, gross national product, net domestic product, net national product. We have to study these products on a particular values, like on market price, on factor cost. So this is all we have to cover in the chapter. Okay, so a little bit introduction of all these terms. If we talk about, let's say for example, if I talk about the gross value, gross means the total value of a product, and gross means the total value of a product. Let's say for example, I have purchased this pen, or I can say this marker, in the year 2022, let's say for example, and I have purchased this marker of 100 rupee. Okay, in 2022 I purchased this marker in 100 rupee, and in 2024 I want to resell this marker. I used it for 2 years. Now I do not have need of this marker anymore. So I'm selling it to another person. And when I'm selling it to another person, can the another person will pay 100 rupee to me? Obviously not, because for the last 2 years I'm using this marker, so somehow its value have been decreased, and that is known as depreciation. This is what? This is depreciation. When the value of goods and services decrease because of its consumption. Or depreciation means, simply you can call the depreciation what? It's the decreased value or used value of a product. So it's very obvious. The total value of this marker is 100 rupee, because it is what the price of marker when it was introduced by the company. Clear? Now, but apart from that, what's the value of this marker today will be calculated with the net value. So net means remained value. It means remained value means after removing all the depreciations, after removing all the value that have been used from this product, this marker or any other product, you have to calculate the net value, and that is your net. So net means remain value. If this marker was of 100 rupee in 2022 when it was first sold, that's the gross value of the marker. And if today I'm going to sell this marker to another person, let's say another person is ready to pay me only 20 rupees because I have used it for the 2 years. So the ink in the marker have been used by me. Let's say the body is not good. Let's say some crack or something is there. So now at present, this marker, the another person is ready to purchase in only 20 rupees. So the 20 value is your net value and the 100 value is your gross value. And it happened with all goods and services. Like let's say, for example, you are purchasing, for example, Royal Enfield today. And in 2024, on 4th of January, you have purchased the Royal Enfield. After 6 months or after 2 months, you have purchased today at 1.25 lakhs, for example. After 1 month, when you are going to sell it, it will not give you 1.25 value. It will give you, let's say, 1 lakh or let's say 90,000 or something else. Okay, so this is why, because for the 1 month period, you have used that value, and that is known as your net value. Okay, now we have domestic product. Domestic product means the production that have been done within the geographical boundary of a country. So when we talk about domestic product is simply when you have the production of goods and services within the geographical boundary of a country. It doesn't matter who is producing. It can be Indian company, it can be foreign company, it can be Indian, it can be foreigner, but it has to be produced within the geographical boundary of a country. That's the condition. Okay. Now, apart from that, we have national product. What is national product? The production that have to be done by the citizen. Doesn't matter where the citizen is. But if the production have been done by the citizen, it will be calculated as national product. Whether it is produced in India or in any other country, that's a national product. And if the product is produced within the geographical boundary of a country, that's a domestic product. Clear? So these are the certain terms you have to remember, and then only we will be able to remember, or we will be able to understand these concepts. Okay, so this is a very basic we have covered here about this GDP concept or system of national account. Let's start, move forward, and we'll discuss further concepts of the same chapter in form of questions. So the first question is talking about the average income of a country is known as. What is the average income of a country is known as? Let me know. Okay. So the average income you are talking about will be your per capita income. The right answer is per capita income. So the average income of a country is known as what? It is known as the per capita income. How to calculate per capita income? Simple. Per capita income equals to national income divided by the total population. So what an individual person is earning in a financial year, that is calculated with the help of your per capita income. So the average income of a country is known as what? Your per capita income. So it is the average of national income, है ना? When you calculate, like if the formula we have written here is the formula of average in the mathematics. So what is the formula of average? Simply sum of all variables divided by number of variables. So national income when divided by total population, it gives us the value of per capita income, and that's the average income of a country. Right answer is CP. Next question, what is nominal GDP? So let's understand first of all what is GDP. So GDP means the money value of all final goods and services produced within this geographical boundary. Let's say the circle is a geographical boundary of a country. Whatever production you have done within this circle, that is known as your GDP. Whether it is done by Indian or foreigner, doesn't matter, but it should be done within the geographical boundary of a country. That's the GDP. Now this GDP can be calculated at two values, that is nominal GDP and you have a real GDP. When we when we talk about the nominal GDP is the same. You are calculating the money value of all final goods and services within the geographical boundary, but at what? At the current prices. And nominal GDP will be calculated on current prices, and the real GDP will be calculated on constant prices. Now, what does this mean? What is the meaning of this? When we call about the nominal GDP or real GDP, it means when you calculate the value of production of goods and services of a country in a financial year, when you calculated the current price, it means you are not comparing with any value you have seen from 1st of April 2023 till 31st of March 2024. Whatever we have produced, what is the value of that production? When you calculate only that value, it is known as your nominal value. That's the nominal GDP. And when it comes to the real GDP, this value of 1st April 2023 to 31st March of 2024, you have to compare with the base year. You will have a base year that is right now 2011-12. With the base year, you have to compare the value and you have to adjust the inflation in that comparison. And when you do so, that is known as your real GDP. And why it is real? Because you are managing or you are adjusting the value of inflation in that. Okay, so right answer will be your Acha, this is the definition. Okay, now let's move forward and see the options. What is the nominal GDP? First is saying adjusted for inflation. No, if it is adjusted for inflation, it's a real GDP because it will be calculated on the constant price. When you're calculating on the constant price, it will be adjusting your inflation. Second, GDP minus depreciation will give you NDP. So it means third is also not correct. GDP that only include domestic production. No. So right answer is B, that is GDP at current market price without adjusting for the inflation. So whatever production have been done in this financial year, only that value you are calculating there. And this is known as what? This is known as the nominal GDP. So what is nominal GDP? Simply GDP at market price without adjusting for inflation. So right answer will be your B. Right answer we have is B. Okay, next question. What is the main difference between GDP and GNP? So you have to find out the main difference between GDP and GNP. When we talk about GDP, GDP talks about the money value of all final goods and services produced within the geographical boundary of a country. Okay, like within the country, how much production you have done, that will be cross-checked. And GNP means citizen have produced goods and services. So in a short way, I will write like this. Whatever production have been done by Indian or foreigner within the boundary, that's a GDP. And in GNP, you will find whatever production have been done by this citizen of your country within the boundary and outside the geographical boundary is GNP. So what's the difference actually? The difference we have here is very simple. Anna, the difference here is very simple, and the difference is that the Indians which are in the foreign country earning and the foreigners which are earning in India, the two will be the difference. Okay, the Indians earning abroad and the foreigners earning in India, that's the difference you have to calculate here. And that's the difference between GDP and GNP. So first is saying GDP includes depreciation while GNP does not. This is not true. GNP also includes the depreciation. Now GDP includes income from abroad while GNP does not. GDP do not include the income from abroad. This is not true. GDP value for domestic company only while GNP includes foreign company. No, GDP also value the foreign companies. That I have already told you. It means this is also wrong. So the right answer will be GDP measures value within geographical borders regardless of what? Ownership. Regardless of ownership means it can be Indian, it can be foreigner, doesn't matter. But it have to be there within the geographical boundary. Second is saying GNP measures value produced by nationals regardless of location. And this is true. Nationals means the citizens. Regardless of location means it can be in India, it can be in USA, it can be in China, it can be in Pakistan. Doesn't matter which location is it. But it have to be produced by the citizens. So right answer will be your C option. Right answer we have is C. Okay. Next. If a country's GDP is rising, it could indicate that. If the country's GDP is rising, it could indicate what? A, B, C, or D? Okay. So if GDP is rising, what is GDP? The production within the country. That is the GDP. So when it's saying that the country is importing more goods and services, no. The country's population is decreasing, no. The country is producing less goods and services, no. The right answer is B, because the country is producing more goods and services. So when GDP is rising, it means more goods and services will be produced within the geographical boundary of a country. So that's why the right answer will be your B option. That is when the country is producing more goods and services. Okay, right answer is B. Next question. What does the concept of green GDP aims to incorporate? Achha, now if you remember, we have talked about climate change and sustainable development. There we have studied the green finance. There we have studied the green bonds. And we have talked about like green finance and green bonds. What are they? They are simply, you can call the way of raising capital in such a sense that whatever money you are raising, that will go to only your environment-friendly products or environment-friendly projects or environment-friendly industries. That's the green bond, that's the green finance. And when it comes to the green GDP, now we can understand it is somehow related to the environment. Okay, so it's the way of calculating the production of the country that actually calculates what is the impact on the environment. So first is saying the extent of financial inclusion, obviously not. Achha, what is financial inclusion? Now this is your kind of homework that you have to let me know in the comment section. So whenever you are watching recording, do drop a message after watching or after completing the session, like what is financial inclusion. I have discussed this so many times in the paid classes as well as in the YouTube as well. Okay, so do make sure you check this. What is financial inclusion? Do drop answer. The definition of financial inclusion. Now, the health and education level of a country, obviously not. The earnings from the external sector of the country, no. It is the environmental effect of economic growth. The environmental impact of economic growth will be calculated or will be taken care of under the green GDP. So when you calculate the green GDP, you also check it's not like how much production have been done. You also calculate what happened with the environment. What is the impact on the environment? That will also be calculated. So the right answer will be your C. Okay, right answer we have is C. Next. Next question is factors of production. Which of the following is the factor of production? Factor of production. So there are 4 factors of production. How many factors of production are there? 4 factors of production are there. What is the meaning of factors of production? Simply those goods and services, not the goods and services, actually we can say factor of production is the thing that you use for the for creating manufacturing goods, for creating finished goods, for creating final goods, whatever you can say. So the things which is used for the manufacturing of goods and services, that is known as your factors of production. There are 4 factors of production: land, labor, capital, entrepreneur. They all are required to manufacture anything, to produce anything. So the right answer will be your C. These are the 4 factors of production. And out of land, we have earning of rent. Labor have earning of wages. On capital, we earn interest, or the entrepreneurs are earning profit. That's the income that they are doing on the factors of production. Now, what is the net domestic product? Now, how to answer this question? First, you have to have in your mind what actually the NDP is. So if there is a domestic product, it means production within the geographical boundary have to be seen. It means in the option within geographical boundary is the keyword that you are looking for. Second, net, it means the depreciation have to be deducted, or we have to exclude the depreciation because you are calculating net value. So you have to have in your mind that 2 keywords you are looking for. First is within geographical boundary. Second is excluding the depreciation. So first is saying the total value of goods and services produced within a country's border. So this have been done. Okay, this is true. But including depreciation, you have to exclude. So first is not correct. Second is saying the total value of goods and services produced within the country. The first keyword we have got, but the second keyword is saying without even considering the depreciation. This is also not true. Then the total value of goods and services produced by country's citizen. Now we are not getting our first keyword here. Okay. So the last option is the total value of goods and services produced within a geographical boundary or country's border. The first keyword is there, and subtracting depreciation, the second keyword is also there. So the right answer will be D. So NDP is the total money value of all final goods and services that is produced within the geographical boundary of a country. Okay. And what? And the next thing is subtracting depreciation. Clear? So right answer will be your D. Next question. Next we have the personal consumption expenditure of household divided into. Like if we talk about individuals, like if we talk about our households, what products we are consuming? We are consuming durable goods. We are consuming non-durable goods. We are having certain types of services. It means what? It means all of the above. The right answer is all of the above. So personal consumption expenditure of household divided into all of the above. Next question. What does GNP primarily measure? What is GNP? Gross national product. So up now you have to have in your mind, first it is a national product. Like the first keyword you are looking for is citizen. Citizen have to be there, doesn't matter what is the location. Then because it is gross value, so you do not have to depreciate you do not have to subtract the depreciation. Okay, citizen should be there and there is no need of depreciating subtracting the depreciation. Clear? Do remember these 2 things. Now, first is saying the total value of goods and services produced within the country's border. Wrong. The total value of goods and services produced by country citizen. This is true. First keyword we have found. Second, regardless of where they are located. This is true. Doesn't matter where they are located, but the production have been done by the citizen, and this is your right answer. So your right answer will be B option. Right answer is B. Clear? Why not third and fourth? Because the third is saying the total value of goods and services adjusted for inflation. This is not. This is your real GDP. Okay. Now the total value export minus import, it means your net export. It is the value of your net exports. And it was asking about your GNP. So the right answer is your B. Not A, not C, not D. Right answer is B. Okay. Next question. Market price is the dash price for which a good or service is offered in the marketplace. Next question we have is, market price is the dash price for which a good or service is offered in the marketplace. So the price at which you are offering your goods and services in the market is what? It's a nominal price, it's an economic price, it's a marginal price, it's a deficit price. So your right answer will be what? It is your economic price. The right answer will be your B. It's your economic price. Okay, right answer will be B. Okay, done. So this is the certain questions we have discussed about the system of national account and GDP concept. Now you have to let me know how many answers you have given correct. Also in the comment section, you have to let me know what is financial inclusion. If you have any doubt, you can ask in the comment section. I will take your comment and answer there. Okay, so this is all for today. Now let's move forward, and there is one big information for all of you, that resolution batch is going to start from 10th of January, and I will be starting principles and practices of banking in this batch from 10th of January in the evening 8 to 9 p.m. So this is the first subject we are starting, and why we are starting with the PPP, because it has a huge syllabus. And it has a huge syllabus, so it will be better to start early so that we will end this early. So your batch the batch is going to start from 10th of January. How to enroll? First of all, just download the Adda 24/7 application. Okay. After downloading the application, you have to go to the exam category. That is your JAIIB, CIB. Here the exam category is. Then go to the JAIIB May 2024. You will find all the batches available here. Click on the view all offer and you will find all the batches. Okay, all the batches are available. And you can see resolution batches here. This is starting from 10th of January. So how to enroll? Do check the offering, check the validity, click on the buy now option. If you use this code NY75, you will get only 75% discount. So what you can use? You can use the code Y496. Click on apply. After applying, you can see you are getting here 78% discount. The 1% additional discount will be there when you use the coins on the application. This is a 78% discount by using the code Y496. Okay. And this is how you can enroll yourself in the upcoming resolution batch starting from 10th of January. And the same process have to be applied while you are purchasing any other batch. Okay, the process is same. Now, apart from that, if you want to join the YT sessions regularly, for that you have to subscribe the channel Officers Adda 24/7 and press the bell icon so that all the upcoming sessions notification will be given to you. And if you want to join IFS session regularly, do join Monday to Saturday at 7 p.m. only on Officers Adda 24/7. And for the same, for PPP is available in the morning at 6 a.m. Okay, so whatever sessions you want to attend, first subscribe the channel and press the bell icon so that you do not have to miss any session here. Okay, so that's all for today. Thank you all for joining the session, and if you have doubt, you can ask in the comment section. So see you in the next class. Till then, take care everyone.